Early in the second quarter of 2020, Refinitiv's Cornelia Andersson joined us to talk about the collapse in global M&A volumes due to the pandemic. Now, whilst M&A activity rarely translates into immediately actionable opportunities, I still wanted to ask Cornelia about the evolving trends that may impact markets in 2021.
What a year 2020 was for M&A. It was really a tale of two halves. So in the first half, we saw activity virtually grind to a halt, and there was very little going on. Then, as we approached the summer in the second half of the year, we had an absolutely record second half of the year for M&A activity. So talk about a rebound. We saw volumes return in the second half of the year that took us almost up to where we were in the year before. What we've seen is really a situation where, as the year progressed, the large corporates in particular spent the first half of the year dealing with the shock of the initial crisis. So they spent a lot of time shoring up their balance sheets, making sure that they had access to appropriate funding. And then as we moved into the summer, large corporates largely got comfortable with the new normal, and they started to revise their M&A strategy, and they started to be open to doing deals again. So we have absolutely seen the return of the mega deal. So once again, the second half of 2020 was a record time period for mega deals. And by mega deals, we mean transactions over $5 billion. We saw almost $1 trillion worth of mega deals. And these are really the large corporates that are, they have deep pockets. They have access to very cheap debt financing. As we know, in this low interest environment, that is a big driver of M&A activity. And with a renewed sense of confidence.
The obvious explanation for this activity is that we are seeing consolidation as well as sector-specific concentration in areas such as tech, where cash balances are high and there is easy access to cheap capital.
We're seeing a trend of consolidation in several different industries. The asset management industry in the UK is in Europe and the UK is a very good example of that. Whereby we're really seeing the dominant players focusing on their smaller rivals to be able to achieve that scale, to manage their cost bases, to tap into new customers in new markets very, very effectively. Overall, technology had a massive year in terms of M&A. So we saw some very, very large transactions there. And what I personally find is very interesting is the renewed focus on workflow and collaboration tools. So as a result of the pandemic crisis, we're all working virtually now. So there's a renewed interest in these types of tools. So a great example is Salesforce acquiring Slack for $28 billion. A mega deal, a technology deal, a large corporate deal. So that deal really hits on the key trends that we've seen in 2020. One of the very interesting things is that we've seen an uptick in cross-border deals, right? So you might almost assume that the opposite would happen in this type of situation, right? When there's a global crisis, we've also had plenty of geopolitical tensions. We've had uncertainty in lots of different local markets, but we've actually seen an increase in cross-border deals, meaning that corporates are increasingly looking at global opportunities. If we look at the three major regions, we've seen a downtick in activity in the Americas, particularly the US, and instead we've seen much more activity in Europe and in Asia. In fact, 6 of the largest 10 deals in 2020 took place in Europe. And if we look at Asia, it's a very encouraging story because Asia saw the impact of the pandemic crisis first, but they've also seen the recovery much sooner.
Despite the collapse in deals in the first half of 2020, private equity was sitting on a lot of very dry powder and was standing ready to deploy that capital.
So, so there's a couple of key trends, a couple of drivers of the dramatic upturn in M&A activity that we saw in the second half of 2020. And one of the key drivers here is private equity. So back in April, we called out private equity as one of the likely drivers of the recovery in the Corona correction series. And if we look at the data, we see an increase of 27% in financial sponsor-backed buyouts. So these are really the transactions that are driven by private equity firms. So interest rates are low, investors are willing to invest in growth, and there are plenty of opportunities as a result of the crisis that were not available before. So it's really the perfect conditions for private equity firms to execute.
Low interest rates have fueled the late 2020 surge. Rates are set to remain low in 2021, but debts have increased and yields are starting to rise, and this could impact future volumes.
So when it comes to the interest rates, central banks across the world have certainly flagged that we're they're expecting to remain in a low interest rate environment for quite some time. So we're probably not going to see any major impact there. So it's likely the debt financing will continue to remain relatively cheap. However, we have had a record year on the capital markets front as well, which means that there's a number of corporates that have refinanced and they have raised additional capital and now are dealing with a fairly heavy debt burden. So the question is, are they going to be able to maintain that going into 2021? Or are we going to see an increasing number of distressed companies, thereby resulting in distress-driven M&A? So I think there's a good chance that we'll see that towards the end of next year. Additionally, we will absolutely see more mega deals next year, and that trend is not going to change. We will see more private equity. We'll also see technology continue to dominate as a sector.
In many ways, M&A echoes the broader financial markets. It's been a boom for companies with access to cheap funding or sitting on cash piles. Large cap corporations with access to capital markets have been in a strong position, but leverage has increased. Meanwhile, smaller companies such as family businesses have struggled to remain solvent. Historical returns to large cap companies acquiring other large cap names have been poor, but in a world where passive flows favour the largest listed corporations, the benefits in this cycle may be as much to do with fund flows as they are to do with improving the business model. Big years of M&A have often preceded poor years for markets such as 2000, 2007 and 2019. But as we've discussed before, maybe the influence of central banks can break that historical pattern. And you can now get the big conversations from Refinitiv as a flash update on your Alexa device or Google Assistant. And if you want to know more about how to download it to your smart speaker, please go to refinitiv.com/flash briefing.